We are using mobile phones more than ever, so much so that the small screen is unseating traditional marketing, offering a direct gateway to consumers. Affle India, a key player in connecting the marketer to the consumer in the modern advertising ecosystem, listed on the exchanges last month with a positive response. To tell us more about the progress since then, as a publicly traded company, joining us on the show right now is the chairman and managing director of the company. He is Mr. Anuj Khanna Sohum. Anuj, thanks very much for taking out the time. It's been a month since you've listed. You had a good response during the IPO period. What has it been like in this last 1 month? And also, can you talk a little bit more about how do you anticipate the company to grow come this year, considering that you have a track record of a CAGR growth of 32%?
Well, thank you for having me here. The post-listing sentiment within Affle has been at an all-time high in terms of levels of pride. And I'm talking about all Afflers, their families, the employees, the customers, partners, investors. I think the sentiment of a successful IPO is been very positive across the board. And I think that's adding to a halo effect on the otherwise anyways a fantastic business and a stellar historical track record, as you mentioned, of a CAGR of 32% and higher. So that's where we have been. And going forward into, let's say, building the company as a public company, having a 14 years track record of doing well as a private company has put fairly high yardstick. So when I look at the next 5 years of our organization, I'm seeing some very, very positive mega trends supporting us in terms of smartphone devices being used by consumers in a very, very heavy way, not only increasing in terms of number of transactions consumers are doing, but the average value of a transaction that the end consumer is doing from their phone is actually going up tremendously. And that's causing the advertisers and the marketers to shift disproportionately their marketing spends from traditional media to digital. And if I may say, digital in emerging markets, which is 80% of where Affle operates today, is actually just mobile. And so therefore, our outlook for, let's say, next 5 years is at least as good as how we have done in the last 5.
That would be 32%. But just tell me one thing. If the outlook is so positive, you would have probably seen initial trends of ad spends picking up. How much of a growth are you anticipating? What are the kind of growth in volumes in terms of clicks? You just spoke about all that. You touched upon it. Let's just get into details of that.
So I think I don't look at our business as a business of about impressions or clicks per se. I think the way I look at our business, especially for Affle India, is that we are driving conversions with consumers on the phone for the marketers. Whether it is a new user acquisition or a repeat user transaction or a conversion whereby the user looks at the ad on their phone within an app, but actually decides to, generate a footfall into a retail offline store and do a purchase or a conversion over there. So as a platform that's driving consumer conversions, the way we look at it is, what is the consumer uptake? What is the willingness to make payments from mobile phones? And if you look at all of those trends, they are actually set up very, very favorably. So the way to look at our business would be look at how the smartphone adoption is happening. What is the percentage of shoppers versus non-shoppers through the smartphone? So if India, let's say in the last financial year, we saw over 550 million smartphone devices connected, we only saw less than 15% being potential shoppers within the country. Going forward, I expect the number of smartphone users to grow disproportionately in the next 3 to 5 years, and more aggressively in terms of the number of shoppers that would grow. So hopefully the number of shoppers would move to 30% of the smartphone users to even 50% of the smartphone users in the next 3 to 5 years. So those are the consumer trends that we would like to track. I think impressions and clicks is very passé, and we have to look at it as an industry moving beyond that.
Okay, so let me ask you, what's your track record been in terms of new user conversion of the existing user, conversion offline of the new and existing user? How has the growth been?
So historically, what we've seen is if you look at FY18 versus FY19, I think all this data was in our prospectus as well. We drove around 26 to 28 million conversions in India in FY18. We grew that to close to 40 million conversions that we drove in the last financial year, FY19. So the growth rate is in line with the kind of revenue growth rate that you've been seeing. It's a very clear, direct driver of our business. If the consumers are converting, the advertiser would definitely come on board and pay proportionately, if not better. So we are seeing a consistent growth trend there in terms of consumer conversions, as well as in terms of how the advertiser spend is translating into revenue for us.
Okay, got that. And how has that been going in terms of the ad spends and the increment there?
So in terms of the ad spend, the way you could look at it is that, previously the advertisers are spending a lot more on traditional media, and now they're shifting aggressively towards digital. And I mean, that shift has been slow. Running this company for 14 years, I've seen the market literally being born. And, in the last 5 years, we've seen at least 25% growth rate, at least from our customers, right, in terms of how their increasing spends are happening. So we take a slightly larger share of that in terms of delivering the 32% CAGR revenue growth because of our conversion focused metrics, where we are not so focused on impressions and clicks, but we are more focused on actually driving ROI for the advertiser. There's only one objective of an advertiser spending ad spends, is to drive their sales. And we measure that by saying that if we have delivered a qualified shopper to you, whether online or offline, then that's the way we charge our revenue. So we are seeing that we are disrupting not only digital but bringing mobile advertising in a very different way, not just doing impressions and clicks or a SaaS platform-based model, but more linking it to business outcomes. So if we drive a conversion, that's when you charge the advertiser, not for all the other metrics that have been traditionally followed by digital advertisers.
Okay. Anuj, the company's margins have improved significantly. Now, from FY16, when they were at 2.3%, to FY18, when they came to about 22.3%. Is that the trajectory that you're going to follow, or probably even maintain? Because this is a tough environment. And 23%, is that something that you will be able to maintain?
So last year, our PAT was about 19% on a console basis, if I'm recording the numbers correctly. If you look at PAT as the guiding number, then we definitely aim to maintain that, because our business is unlike IT services companies, which are very manpower or OPEX heavy. In our case, we are a tech platform company. So when we grow our revenues, our headcount and our operating expense doesn't grow in line with that. So there are bottom line efficiencies in our business. So when we grow our revenues, we hope to drive much better growth on the bottom line overall. So it is fair to say that in tougher market conditions, we should at least maintain that kind of performance in terms of the financial bottom line metrics.
Just one last question. A bulk of your spend in proportion of the revenue goes on data and inventory cost, I think 50 to 60%. Is that something that you're looking to bring down or take it up? And the employee cost for you is a big part as well. You've managed to bring it down from 22% to 14%. Are you looking at probably squeezing that a little bit more?
So there, I would say we don't bring down the employee cost first and foremost. We actually consistently are growing our employee base. Of course, there is, appraisals on a normal basis. So that cost on absolute terms has been growing. But revenues have been growing faster than the OPEX. And therefore, as a percentage terms, you see that as a percentage of total revenue, that OPEX is lower. In terms of data and inventory cost, yes, I expect that to continue to be in that 55 to 60% range in the long term, because we don't see it as an expense, even though we expense it fully in our P&L. It's a necessary investment. Think of it as data and research, or research and data costs, because when I ended FY19 for Affle with a huge amount of data asset, which has been fully expensed out in our P&L. But when we go into FY20 or even beyond each year, that data asset is an invaluable asset of the company driving the growth of the organization. So when you look at the financials and you see it as, it's a big expense item, it's actually a necessary investment for the continued growth of the business. And I wouldn't necessarily want to bring it down. It's the optimal level is 55 to 60%. Anything lesser is not a great sign, perhaps. Anything more is perhaps not optimal for the bottom line performance. So my view is that Affle will maintain that range for next several years to come.
All right. Anuj, it was great chatting with you. Thank you so very much, and best of luck for the upcoming quarter as well.
Thank you very much.